The Federal Reserve has three tools in its monetary policy toolbox. 1, the setting of reserve requirements. 2, the setting of interest borrowing costs for the banks. That's the federal funds rate. And 3, a quantitative easing or tightening tool, QE and QT. The Fed rarely changes bank reserve requirements. That's tool number 1, because such a change has a large, immediate, and universal impact on banks. In the normal course of events, the Fed is trying to impact banks and the economy in a more nuanced way. The public is most familiar with the second tool, the federal funds rate, Fed funds. This is the rate the Fed charges banks when banks borrow from the Fed. That happens when they're short of reserves. Generally, the Fed funds rate plus a margin is the lowest rate available to the public. At the margin, a bank's cheapest and most immediate source of funding is the Fed funds window at its local Federal Reserve branch bank. There are 12 such Federal Reserve branches organized into territories: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and the 12th one is San Francisco. In order to make a profit, a bank must charge its new loan client a premium above its own cost of funds. And that's why most bank loans have a floating rate, which changes when the Fed changes the Fed funds rate. As a result, when the Fed raises or lowers the federal funds rate, market rates rise or fall. As interest rates rise, fewer and fewer business investment projects make sense. In a 1% interest rate environment, a project with an internal rate of return of 3% makes sense. But that project is a no-go if the borrowing rate is 4%. In high interest rate environments, new investments fall, and that slows down economic growth. This interest rate tool of the Fed often acts with long and variable lags, as has recently been the case in the current 2023-2024 time period. There was a projected period of low interest rates after the financial crisis and resulting Great Recession in 2007 to 2009. During that period, the Fed kept interest rates low, near 0%, until March of 2022, when it implemented the first of 11 rate increases to combat an outbreak of inflation. It moved the Fed funds rate from a 0% range to a 5.25% to 5.5% range over a 16-month period, March of 22 to July of 2020. At this time, May of 24, the economy has begun to weaken. GDP growth fell from 3.4% in the fourth quarter to 1.6%. While the Fed has not yet indicated a willingness to lower interest rates, the Fed's chairman, Jerome Powell, told the media on May 1st that the next move will be to lower rates. So it just appears to be a question of when, not if. Second and more powerful but less nuanced tool is the quantitative tools, quantitative easing, and quantitative tightening, QE and QT. While QE and QT have always been available to the Fed, they weren't discovered until then Chairman Ben Bernanke used QE to effectively combat the Great Recession. These quantitative tools are nothing more than an expansion or contraction of the Fed's balance sheet. Say the Fed purchases $10 million of Treasury in the marketplace. The seller of those bonds, let's call that seller Mrs. Smith, now has a check for $10 million, which she deposits into her bank account. The bank now has a check drawn on the Fed, and its reserves go up by $10 million, and that is a net $10 million to the banking system in general, because the check was drawn on the Fed, not another bank. Because it's a check drawn on the Fed, it's a net addition to bank reserves, and through the multiplier effect of the fractional reserve system, reserve requirements are 10%, implying up to 10 times or 100 million in new loans, and therefore new deposits. Bankers tell their clients when they make them a loan, it's in their checking account. Quantitative tightening is the opposite of quantitative easing. Here, the Fed sells from its vast Treasury holdings. Say it sells $10 million. Whoever buys those bonds pays with a check drawn on a commercial bank. The Fed cashes the check by lowering that bank's account at the Fed, which directly impacts that bank's reserve balance by $10 million. In effect, total bank reserves are now $10 million lower. If there are no excess reserves in the system, banks in total must shed $100 million of assets because of the fractional reserves. Ultimately, those assets shed will be loans. In the scheme of things, the economy potentially responds the fastest to QT because it immediately reduces reserves. If the economy is running too hot and banks have few excess reserves, quantitative tightening has a rapid impact. If, on the other hand, there are a lot of excess reserve, quantitative tightening takes longer. Quantitative easing, on the other hand, is a slower process. First, there has to be demand for loans from businesses. In a recession, that demand may be low, and it may take time to develop, even when interest rates are falling. In the current tightening cycle, the Fed has used its interest rate tool, the Fed funds rate, along with quantitative tightening. It began raising rates in March of 2022 to combat inflation. The theory is that higher rates will slow the economy and dampen demand. Over the course of the tightening, to this date of this recording, we have seen inflation fall from over 9% year over year in the CPI to the 3% area. 2% is the Fed's goal. Thus, while there may be some bumps in the road as to how fast inflation approaches the 2% goal, the campaign against inflation appears to have been effective. The Fed has also used its quantitative tool. In June of 2022, it began gradually reducing its balance sheet by not reinvesting the cash from interest coupons and maturities in its vast Treasury and mortgage-backed securities portfolios. As of March 31st, 2024, the Fed had reduced its balance sheet from $9 trillion to $7.5 trillion, thus extinguishing $1.5 trillion in bank reserves. On May 1st, the Fed announced a slowing in the pace of its securities runoff from $60 billion a month to $25 billion. Note, while this is still quantitative tightening, it is less quantitative tightening. This is the Fed's very first move towards ease through a less tightening. The Fed believes that a neutral Fed funds rate is 2.5%. Whether there is a recession or not, the Fed will eventually have to move rates towards this neutral position. Chairman Powell has specifically said that the Fed is not considering additional rate hikes, and the dot plot, the individual projections of future rates by the members of the Federal Open Market Committee, that's the Fed's rate-setting committee, indicate lower future rates. As a result, at this time, lower rates appear to be a matter of when, not if.